like to please welcome to the stage Zachary Kelman.
Well, I'll give you a little bit of my own background. I think that my presentation is going to depart a little bit from some of the others because I am a U.S. trained attorney, but I've been overseas for the past 4 or 5 years. I got into the space around 2013, 2014. Around that time, I thought this is very in need of regulation. Had much of the same kind of view of many people on stage that regulation is not a bad thing, and without it, I don't think this industry will be rife with problems. And so we should try to do what we can to have smart regulation. But at this time, this is prior to the New York BIT license, it was, you go to these meetings with people and they just kind of thought, this is exempt from regulation, this is not a security, this is not a commodity, this is not money. It was just kind of impossible to get anything going. And I think for the most part, regulators just saw it as a money laundering vehicle. Whereas overseas, people thought of it very differently, especially in jurisdictions which have had to deal with de-risking and lack of access to the banking system. So their thought was much more open-minded. So my initial foray was I wrote a bill called the Online Market Protection Act in 2014, tried to get it in Congress. It eventually did get to Congress, but I don't think they even voted on it. But what it would have done is exempt any kind of transaction that's not involving actual fiat from regulation. So if you have an exchange and it doesn't have any fiat cash in or cash out, it would have been exempted. But those were very early days, and nothing happened. So I ended up going to the Caribbean to work for an exchange down there, and I've been in Philippines as well. You guys, I wanted to start by showing. Oh, hold on one second. I wanted to start by showing a little video. I don't know if any of you guys have seen this before.
They're just working on pulling it up for you right now.
Okay, sorry. Yeah. Well, I guess I can get into the presentation a little bit first. Yep, that's me. Although I look a lot younger there. But anyway, I was going to, let me know, it's not going to happen? Okay. Well, anyway, the presentation, or the video, essentially showed the rise of ICOs and sort of where they were located. And the reason I chose to show that, you can find it online, it's pretty easy to find it, but you can see how ICOs, I think we all know, exploded in 2017. But what this video showed, which was interesting, is where they were jurisdiction. Because if you look at the jurisdictions where they're located, Europe has a lot more ICOs disproportionately to its share of the global economy. But then more recently in 2018, you've seen an explosion of them based in the Caribbean, which is a very small percentage of the world economy. And you really start to see a pattern of cryptocurrency moving offshore, away from jurisdictions like the United States. As I mentioned earlier, is similar to what happened with online gambling, where banks deregulated them and de-risked them and said get out of, through the correspondent banking system and AML control, so these are high-risk entities, eventually saying, these are all, you're not allowed to onboard them, but somehow they found a way. So I'll get into that stuff, but I wanted to do, the point of this presentation is to give kind of a broad overview of the history, first of AML, compliance regulations, and then ultimately getting into securities law and how different jurisdictions have approached cryptocurrency, and finally where the general direction seems to be. And this is sort of more of an international approach. You got the video?
I think we do.
Okay, all right, here we go. Yep, so, yep, and this one, you can't see where it is. It's stateless. I think that one might be Namecoin. And there we got Ethereum. Those blue ones are Switzerland, typically. And if you look at the upper left, you can see the total fundraising ticker. So it's only $38 million raised in the entire history of it up until, see, around mid-2015. Yep. This is where it gets good. Yep. And that red is the Caribbean, right? Yeah, I don't, maybe, is there a way we can send a link? If anyone wants it, just message me, my contact details will be on there, I'll send it to you. But anyways, yeah, I think the point of this is to think about your knowledge of global GDP and where these ICOs are being placed. Yes, a lot of them are in North America, although I would say even the North American ones, an outsized number are Canadian compared to the Canadian economy. But, you know, Caribbean is massive, Asia, and obviously there's a huge outsized presence in Europe. Compared to relative GDP. Anyways, yeah, the main point of showing you this is to show it's easy to get our heads wrapped around U.S. law. I mean, most of us here are U.S. attorneys, and we have this assumption that things are going to continue as they are, but there's a real market pressure on the regulators here and on the direction of how regulation is going, and we can't just assume that that cryptocurrency projects would rather be here or that they'd rather comply with the rules. To some extent, we're going to have to contend with the technology itself, which is emerging and has different properties than anything that's been sort of we've tried to box in before. All right, so how do I make the next slide? Just raise my finger, okay, yeah. Again, there's the front page. Okay, the next one. Yep, one more. There we go. Okay, yeah, so again, broad overview, Bank Secrecy Act from 1970. It was the first major AML rule. It really was just a record-keeping rule, required people to keep track of their customers and have some sort of data notifying, you know, for future, oh, thank you, for future use regarding who they are. And, you know, there was nothing like we have now. Well, we'll get into this in a second. Now, obviously, someone mentioned earlier we have the 5 rules, but yeah, you had 4 rules. You need to have a compliance officer. You need to have policies and procedures. Employees need to be trained, but again, you know, I think for most people that have worked in AML, often this gets treated as kind of a check mark, and then some sort of independent audit. But again, if you look at this system, it's not very robust. You can see how you could have lots of transactions going on that we wouldn't know about. There's no transaction monitoring component, and it's really more just allowing financial institutions to be data repositories for potential law enforcement activity. But that changed with the Patriot Act, which had broad requirements for transaction monitoring and surveillance for all customers and risk-based approach, which has recently become the 5th pillar. I should note the reason I'm laying out AML controls is because it's been huge in the regulation of cryptocurrency, and overseas it's probably the most important area of regulation for cryptocurrencies, because this is the way in which the U.S. regulatory regime projects power. You know, if you're in another country, especially some of the smaller Caribbean countries I've worked in, their largest concern with U.S. regulation is, will our banking system be de-risked? Will our businesses have to go out of business? And that's actually happening on a very wide scale down there. But starting in 2001, you just saw a very broad statement in the Patriot Act stating you need to do transaction monitoring, you need to sort of have some system for recording transactions and looking into them. And you didn't see any real crackdowns and until the financial crisis, which turned public opinion against the banks. And then a couple years later, you really started to see massive penalties. But I think this lays out an interesting perspective on how regulation ideally should work, which is you create, and especially in a common law system like the United States, you create broad rules about how what you want the participants in this market to be doing. So in this instance, it was, we want you all to create transaction monitoring tools. We want you to risk rate customers based on what we already know about money laundering, and and we'll give you time to figure it out. And so it took about 10 years before you started seeing real penalties, but as time went on, they were able to measure the different companies, licensed financial institutions, their different programs, figure out what the average or median sort of industry standard looks like, and then measure everyone against it, right? And you can see how it's severe, and I think it's worth noting, yes, they took a balanced approach to compliance, but when they ultimately decided to bang the gavel, it was very harsh. I mean, if you look at the HSBC $2 billion penalty, for example, just to wrap your head around it, you could hire, I think, something like 200,000 compliance, or 200 compliance officers, pay them $100,000 each for 100 years to equal that amount, right? So it's a big team. And prior to this, you didn't see a lot of large compliance teams in these banks. One thing that's also worth noting with Bitcoin is that Bitcoin was founded in some, arguably if you read all of the correspondence from Satoshi Nakamoto, in part to deal with the financial system. Because, I think he was concerned, if you read all of the correspondence, about a crashing financial system, wanted to sort of internationalize it and give people access to it and sort of remove the human element from it. But, as I'd mentioned before, the approach to compliance with cryptocurrency was hands-off. It was, let's apply AML controls to it. At most, you have the BitInstant case, and you have Silk Road, which I'm sure most of you are familiar with, where a website which allowed people to pay in cryptocurrency for services which were illegal, the website host became liable for it. But during this period, it was very difficult for anyone in cryptocurrency to get a bank account. And it's obviously difficult now, but it was exceedingly difficult then. It was seen as de facto money laundering to some extent. And we actually saw around the same time an anti-competitive lawsuit in Australia, which said that the Australian banks were competing with cryptocurrency, that Bitcoin was a potential competitor to banks, and that therefore banks not allowing companies to have accounts there was an anti-competitive action. Now the Australian Competition and Consumer Commission ultimately found that there was no sort of scienter. They didn't find that there was no intention, but they found they couldn't prove collusion, that the banks got together and agreed to go after Bitcoin. And I think if you read the excerpts from the cases, and what you'll find is that the banks more or less said this does increase money laundering risk, and that's why they can't have these customers' accounts open. But I think during this time it does give you food for thought, because I think it can be argued that this system is competitive with banking. Anyway, this is an article around that I had written, but it was around this, kind of making the same point, right? I'm running out of time here. All right, so let's get to securities laws. And again, the reason I laid out the AML stuff was, I'll get to it in the end, but it was also to show this is a responsible approach to compliance. You lay out the rules, you let the market react to the rules, they're broad enough where people can come up with different approaches, and then after you've given it time to sort of become an industry, then you come in afterwards, right? So securities law, the first thing that happened that we saw was the Mt. Gox collapse, which I think attracted the New York regulators. Now it's worth noting, obviously we know New York has a vested interest in regulating financial institutions because of the banking system being centered there. But what you saw beginning right around the time of 2014, although they did start drafting the BIT license before then, but which ultimately came out in June of 2015. But you saw this very onerous New York BIT license, which essentially applied the same kinds of capital controls, AML controls, all of the state banking rules to crypto companies. And the reaction was they all left. There were very few financial institutions that would apply for it. Circle ultimately did, Coinbase. But for the most part, crypto companies like Kraken and some of the others that were originally based there left. They said we don't want to have anything to do with New York. And so the heavy-handed regulation pushed out companies. And I do think this is an important cautionary tale. And if you think back to the slides or to the video, the flow of companies away from jurisdictions which are cracking down on crypto is beginning. The Caribbean, which it's a real easy shorthand because it's mostly offshore jurisdictions, and I know increasingly projects are being based there. That's a good shorthand to look at that beginning of a trend, and you'll note it didn't really begin until 2018. So if anyone messages me, I'll send you the link. You'll see there wasn't a huge offshore crypto industry until a few months ago, and now it's burgeoning. The SEC became interested after the Dow hack, and you can read the Dow decision from last summer. What they said simply was the Dow is essentially a company. For those who aren't familiar, the Dow was a project where people could buy tokens in the Ethereum platform. The tokens would presumably give you a right to profits made off of projects which those tokens could also vote for. It wasn't all on-chain stuff, like you could, for example, vote that someone would build a bicycle, they'd then sell the bicycles, and presumably you get the profit back. Now, for those of you who are familiar with the Howey test, it's pretty on point. You know, you're clearly relying on the labor of somebody else as a passive investor to derive profit. So they said this is a security token, but that was what they did. They didn't say this is a security token and this is a utility token. They just started carving out a piece of it. And again, I would note, in my perspective on the SEC, is that they've been pretty responsible for the most part, and that was probably a very good way to start. Well, I'm going to go back to this. And then, you know, I think the more interesting decision was in December of last year, the Munchie decision, which didn't really discuss about the securities angle, but looked more at consumer fraud in the crypto space, which is endemic to the space. And I don't think it gets enough attention, but the number of projects that are being launched, which are essentially Ponzi schemes or frauds, is massive. And for consumers, it's difficult to distinguish between a fraud and not a fraud, especially for uneducated consumers. And what's very difficult for these regulators is that they want to regulate this space. If they don't regulate the space, then they might be liable, especially since there's so much fraud going on. So the Munchie decision represented a way for the SEC to say, this is fraud. We're not going to say whether it's a security yet or deal with whether there's such a thing as a utility token, but we will say that regardless of whether it's a security utility token, and by the way, Munchie, the cryptocurrency in question in that case, seems a lot more like a utility token, certainly much more like a utility token than the DAO was. But what their position was, if you're selling this like a security, if you're promoting when it's going to get on exchange, how much money people are going to make off of it, if it looks like one of these kind of pump and dump crypto schemes, which we've seen a lot of, even if we don't consider it a security, we're still going to say that it's off limits. So international approaches, this is what I really wanted to build to. So the United States, as I've mentioned with the SEC, has been pretty responsible. The problem is time. Now, what you've probably heard on stage is the general perspective is that the SEC and Congress don't want to pass massive legislation anytime soon. But we have seen other jurisdictions start to do it. Now, some jurisdictions have been too harsh, a little bit like the state of New York. We saw last summer, you know, kind of China has this dance where they ban it and they unban it and kind of go back and forth. South Korea did something similar in January where they had different government officials take different positions and then say, oh, actually, we just wanted something to tighten currency controls and ensure KYC on exchanges. And Russia's been banning and unbanning it as well. But what we have seen more recently, as I mentioned, is offshore jurisdictions. Bermuda just passed a law recently outlining how ICOs can be launched in that country. We've seen Malta is working on it as well, and countries like Belarus and Estonia in Europe have done similarly. And one of the points I wanted to make too is that we had lots of discussions about autonomized exchanges or decentralized exchanges. Now, I don't think it's possible to avoid decentralized exchanges. And the main thesis of this presentation is that we should get out of our heads the idea that we're going to be able to use U.S. law, which is a great principled system which people all over the world trust and want to put their money into, as opposed to other systems that don't have the same credibility. We can't trust that that's going to be a reason why crypto comes here and why it's regulated here, and why people would rather invest in projects based here and based under U.S. law. It doesn't seem to be happening if you look at the direction of cryptocurrency and where projects are being based. And if we don't come up with some comprehensive legislation that would create a new regulatory regime for utility tokens specifically, then I worry that we'll fall behind. There will be a continual flow of projects to the offshore world, also to Europe and other jurisdictions that aren't as harsh, and we'll end up more on the kind of China, Russia end of the spectrum with draconian regulation as opposed to sensible regulation that protects people from fraud. If anyone wants to reach out to me, it's crypto.law. Zachary, crypto.law is the email, but my phone number, everything else is up there. So, yep, that's it.
That's great. We have time for just one quick question. Does anyone have one specific question? Sure.
Thank you. Hi, Zach. I had actually wanted to ask you this on the other panel. Some developers are feeling a pull towards Puerto Rico as a potential place to station an ICO, both on a personal and a corporate level. Do you have any special insights on that? It was interesting. I had that question for you before, and then you mentioned the Caribbean. What are your feelings on Puerto Crypto?
Well, I think, honestly, it has most more to do with a particular bank called Noble Bank that's based out of San Juan than anything else. They've been very open to banking crypto companies. They do have the whole sort of taxation exemption where you can sort of domicile there and avoid paying capital gains. But I think it's more, and interestingly enough, Bitfinex just announced that they're relocating. They're going to use Panamanian companies and bank with Noble Bank there. And they're relocating basically into that system as well. I don't know if it's going to be long term. I do think that if Noble Bank decides to continue to bank these projects, they'll get pressure from the correspondent banking system. And also other banks will decide, hey, if they're doing it, we can do it too. So we'll have to wait and see how that plays out. But mm-hmm. Yep. Yep. But that's kind of the point. Is we can't presume that we can sort of control this thing, because it's unlike all these other areas that have been prohibited by the banking system. Cryptocurrency doesn't need the banking system in the same way. It can still transfer value outside of it. So it's unique in that respect, and the tools we're using are still the tools that we've used on money laundering issues in the past. So.
Excellent. Thank you so much. Thank you so much, Zachary. Appreciate it. Zachary Kelman, everyone.